Good afternoon, advisors, and welcome to the fourth webinar in our 2015 series. This year, again, we focus on a family, the Greens, all four generations. And as with any family, as you hear, there's drama. They're bold and beautiful, they're young and restless, and we'll paint their portrait of risk and look at ways to protect the family and the family business throughout 2015. How will we do it? With insurance solutions tailored to meet their needs as they travel through the days of their lives, filled with glee at times and passion at others. But through it all, and across the generations, they have a guiding light, a trusted team with you, their fee-only financial advisor, and LLIS, the advisor's insurance advisor. Each month's series will last about 50 minutes, and the narrators of these hour-long series know you'll have burning questions. And since they're performed in front of a live audience, feel free to be interactive and type your questions in, and we'll do our best to answer them timely or at the conclusion of the show. Today's episode is being recorded and will be posted to our website within a week in case you missed a pivotal moment in the story. And throughout 2015, loyal fans will receive 10 CFPCE credits, one for each month. The more you tune in, the more you know. Today we focus on Barbara, second generation, and how Andrew, the family patriarch, is helping her to protect her future as well as that of her son Cameron. We have two narrators today. Your first narrator is Jill MacNeil. She'll show us how Andrew and Barbara are planning for the day she may need long-term care. Then Jerry will show us how Andrew is setting Barbara up to ensure she has income, both while he's alive and after he passes, because after all, we all have just one life to live. Let's see how they make the most of theirs. And now to start today's episode, I give you Jill.
Good afternoon, everybody. Thank you for joining us again this month. As another review, we are following the Greens this year for our webinars. There are 4 generations of them, all in different phases of their lives with different financial needs and concerns, and each month we will cover a different issue. If you missed last month's webinar, you can find it on demand on our website. Jerry and I concentrated on Ben and Mary. Ben plans to retire in 10 years and had concerns about the future. Main concern was if he had a long-term care event. So I talked about a traditional long-term care policy for them with shared care, and then Jerry covered hybrid life policy. Again, you can find that on demand on our website. This month, we're going to concentrate on Barbara. A little bit more about Barbara. She's second-generation Green family. She has 2 children, Claire and Cameron. Cameron has special needs. She is estranged from her husband. And after her husband left her, Barbara moved back in with her mother and father, Ben and Julia, and they became what is known as a multi-generational family, which is described as 3 or more generations living under the same household. Cameron, her son, lived with them until he went to live in a group facility for special needs. Andrew's happy to have her back with him. And he's been known to say, I prefer to have them living with me as long as they want. Andrew continues to financially support Barbara. Barbara is retired, and she teaches yoga at a community college, and she's also a board member of several local arts organizations. She has limited resources and receives income from Andrew. Another convenient thing was when Barbara moved back in with her family, with her mother and father, she took care of her mother during her prolonged illness with Alzheimer's. Andrew doesn't want to risk that Barbara runs out of money in retirement. He's providing for her in a number of ways now while he's alive, and he's also wants to take care of her for the day when he's no longer alive. Barbara's never had a lot of her own money, and he's concerned that she may not be adept at managing it. So let's look at 2 ways that he's providing for that protection. The first concern is that they want to protect against a long-term care event, because as I said earlier, they watched Julia, the mother, go through a prolonged illness with Alzheimer's. So with Alzheimer's in the family, they want to protect Barbara in case this happens, because as I said, she's estranged from her husband, will eventually be living alone and won't have anybody to take care of her. The other concern is Andrew wants a guaranteed income for Barbara during her retirement years. So we're going to cover those 2 concerns. First, I'm going to talk about long-term care, And then Jerry's going to talk to you about annuities for Barbara, a hybrid annuity, immediate annuity, and a deferred income annuity. Let's start by looking at the long-term care. And I'm going to look at some facts and figures here. 1 million women become widows every year. The average age a wife becomes a widow is 59. 70% of baby boomers women will outlive their husbands, and 80% of women are single at death. Now, these numbers are certainly important for somebody like Barbara, a single woman that lives on her own, but they're also important for you to keep in mind when you're talking to your clients that are married. So they may be married now, but as we see, 80% chance that they'll be single at death. So it's important for them to prepare for the future and to prepare for that long-term care event that may happen for them. Women age 65 and over. Between 1950 and 2005, the number of women aged 65 and over more than tripled, increasing from 6.5 million to 21 million. And the U.S. Census Bureau projects that by 2030, the number of women aged 65 or over will more than double to 40 million. And with 80% of women single at death, that means there's 32 million single women. And by the year 2050, that number is projected to reach 48 million. So again, with 80% single at death, that means 38 million of them. That's a large amount of women. So these women need to plan for the future. And with this number growing, how is Medicaid going to handle all these women? So it's very important to plan for the future. Here's another figure, some more figures. There's a study that was made by the University of Miami School of Education that I thought was interesting. In the past, when people became widows or widowers, they moved in with their children. Over about 100 years ago, this happened about 70% of the time. But nowadays, it's only 30%. And in 1950, only 10% of all Americans over age 65 lived alone. Today, a full third of older Americans live alone, a figure that rises to 40% at age 45 or older. Contrary to conventional wisdom, this does not represent a decline in children's loyalties to parents, but a preference of older men and women. Almost 90% of older Americans say they want to remain in their homes as they age, and the falling poverty rates have made that choice more feasible for many. So if your clients plan for the future and maybe put a long-term care policy in force, it will help enable them to stay in their homes longer. Because when you purchase a long-term care policy, you have an instant support staff. And that's one of the benefits of having this. Because you don't want your even this more modern version of the Yellow Pages may not be the best option for your parents when they need care. So what hasn't changed is long-term care companies. They have actually changed. They have evolved. And as I said, having the long-term care policy in force gives you an instant support staff. Currently, we're working with 3 long-term care companies. All these companies provide care coordinators. So if that at a time the client or the insured becomes sick, a care coordinator can come to the home and assess the situation and make a plan of care or a care plan. They have an instant resource base. If they decided that the insured can stay in their home, they can help provide or find home health care aid. Or if it's decided that the client needs to move to assisted living, they have a list of assisted living facilities and help with that decision. Think of these care coordinators kind of like a general contractor. They come in, they assess the situation, and create a plan. And they could include adapting their home so the client can stay in the home longer. If you need a ramp, a wheelchair ramp for the front door, they could help find somebody to do that. Or maybe you need updates or changes to the bathrooms to have bars put in for assistance. So again, a care coordinator can provide that, and that's a benefit that a long-term care policy would provide. Because your clients want to let their daughters be daughters, their spouses be spouses, not care providers. Barbara does have a daughter, but Barbara's daughter, Claire, lives far away from her, so she doesn't want to rely on Claire to be able to provide the support for her. So planning for the future is very important for her. Because there are real risks involved if you don't plan for the future. After reaching age 65, the chance that a woman may be involved in a major house fire is 2.6%. The chance that she'll be involved in a severe car accident, 18%. But the chance that she may need a long-term care or may have a long-term care event and need assistance is 72%. That's a huge amount. So your clients probably have homeowners insurance and car insurance, auto insurance, but do they have long-term care insurance? Are they planning for that event? Because there are real rewards for having a long-term care policy in force. The long-term care industry paid a record amount of claims in 2014. They paid out $7.85 billion to 250,000 individuals. That's a 5% increase in benefit payments over the prior year. $7.5 billion to 273,000 in 2013. So this is real money. Let's look at a comparison of the different types of policies that we just looked at. In 2013, homeowners insurance companies paid out $35 billion. That's an average claim of $8,600. Auto insurance paid out claims and liability of $67.9 trillion for an average claim in property damage of $3,231. In physical damage, paid out claims in the amount of $41.7 trillion, so an average claim of $15,443 for bodily injury. But let's look at long-term care. Long-term care paid out $7.5 billion. That's an average claim of $27,472. So your clients really would benefit from having a policy. A lot of times I hear people are skeptical, but long-term care companies hear the stories that they don't pay out claims. Well, it's obvious they are paying claims, and if they weren't paying these claims, they wouldn't be constantly trying to revamp their policies and come up with more consumer-friendly policies and something that the clients can understand, and to try to refine the products so they won't have to have these rate increases that we've seen in the past. So they're, as I said, they're always coming out with new policies, and especially as we look towards the baby boomer generation who will start to use the long-term care policies more every day. Now let's look at how we got to where we are today. That was in 1974. Little known fact, cell phones and long-term care insurance are the same age. They both celebrated their 40th birthday last year. And when you look at long-term care, when it was first introduced, it was very similar to this beast of a cell phone, the initial cell phone. The long-term care policies were not very refined. They were kind of bulky. They were just for nursing home care. They didn't include home health care. Not many people had them. And the only trigger for qualifying for care was needing assistance with 2 out of 6 activities of daily living. There was no cognitive qualification, so it didn't, if you were diagnosed with a cognitive issue, you couldn't qualify for care unless you needed the assistance with 2 out of 6 activities of daily living. Okay? And paid out maybe $50 to $100 a day. In 1987, 88, the cell phone starts evolving and becoming more efficient. And in the long-term care world, the National Association of Insurance Commissioners, or NAIC, released the Long-Term Care Insurance Model Act and Long-Term Care Insurance Model Regulation to provide state regulators with a set of minimum standards and practices for insurance organizations to abide by. Then in 2005, the flip phone was introduced. I'm sure you all remember that. That was one of the phones my kids wanted for sure. The flip phone was a new standard for other companies to emulate. And in the long-term care world, the Deficit Reduction Act provided for additional consumer protections for partnership policies by requiring certain standards consistent with NAIC guidelines. Then in 2007, Apple introduced the iPhone. And in the long-term care world, some companies were exiting the marketplace. They decided it was not the market they want to be in. It was all about competition and refining corporate strategies. So the companies that have stayed in the industry are the ones that really want to be here and want to concentrate on the future. Today's technology is changing the way we live. There are a lot of options. There's the Samsung Galaxy S6, the curved S6 Edge, the Apple iPhone 6, and then the 6 Plus. And the long-term care industry has grown and evolved also. With more experience in claims and lapse rates, they're refining the policies and coming up with new solutions so that the policy can better serve the industry. And now let's take a look at something new that we're excited about. So I have a message that you may not have been able to hear the audio on that, but it was the Pointer Sisters singing, "We're so excited." And we are excited about this new John Hancock policy. John Hancock came with his latest policy in the spring, so about 2 months ago, and we think it's a more consumer-friendly version. It features annually increasing premiums. So the premiums is projected to increase or will increase by little amounts every year. And we think this is nice. So instead of what the insurance companies have done in the past, have waited for several years and then have come out with big rate increases, which are hard to swallow. So these little annual increasing premiums are more similar to auto insurance or health insurance, which we're used to having this little rate increase. So your clients know what to expect, is rather than a big surprise. The policy includes automatic 3% compound inflation. You can upgrade that to a 5% compound if you'd like for the increased premium. Another unique feature of this product is that it offers flex credits, which is similar to dividends. This flex credit would pay out if the company meets certain guidelines or certain parameters, if the earnings on investments or certain minimum thresholds and actual claims experience on these policies compared to assumptions are what they're projecting, then it would pay out these flex credits. And the flex credits can be used for several different ways. Your client can pay long-term care expenses during the elimination period. It can be used to provide return of premium upon surrender, or can be used to reduce future premiums. And this is how we think most people will use it, to reduce their premiums. So you can see this is in a whole different design. We think this may be the answer for the future. Time will tell if other companies will go this way, but again, we think it's a good solution for the past issues with the long-term care policies. But time will tell if this is the wave of the future. Now let's look at designing a long-term care policy for Barbara. She lives in Atlanta, and the cost of care in Atlanta for a private room in a nursing home is $221 a day. And we use what we call the 80% rule at LLIS. So that $221 includes the cost of food and other essentials that she has to pay for, even if she's not in a nursing home. So about 80% of that number is what it would cost her out of pocket. So about $180 a day. We'd recommend daily benefit, recommend a 90-day elimination period. Most people, or Barbara has enough for a 3-month emergency fund. She could go with a shorter elimination period or a longer. Going with a longer elimination period doesn't really save her a whole lot of money, maybe about 2 or 3%. So we recommend a 90-day elimination period. And for her, we'll recommend a 5-year benefit period. As I've said, she lives alone, so the average length of stay in a nursing home is just under 3 years. So most people receive care in their home first. So with a 5-year benefit period, she has some extra time, extra care. And we'd recommend a 3% compound inflation. This will keep the policy growing. If you watched the webinar last month, I showed where nursing home costs have been increasing by an average of 3.9% every year over the last 5 years. So the inflation rider of 3% will keep her policy growing, not quite the same rate as the cost for nursing homes, but it does help it keep pretty good pace. There is an option. Many companies offer 4% and 5%, but the cost for those inflation riders are fairly expensive, so we would rather recommend the 3% to keep the price a medium range. Now let's look at long-term care premiums for Barbara. Here are two companies. As I showed you earlier, we're quoting 3 companies now. So these first 2 companies are policies that have been out for a while. Now, MassMutual is one of the few companies around that are still using unisex rates. They have not moved to the gender-specific rates that most companies are using now. So with MassMutual, they're usually coming in the lowest when I have a single woman applying on her own, because as I said, with the gender-specific rates, the rates are much higher for single women. So MassMutual premium $3,586. It's projected to be level. It can increase in the future, but the company would have to go to the state for the approval. So projected to stay level all through the years. Mutual of Omaha policy is using those gender-specific rates. So this gives you an idea of the difference between the unisex and the gender-specific rates. So Mutual of Omaha, again, is projected to be level, $5,160. Now let's look at the new John Hancock policy that I was just talking about. The default illustration for the John Hancock illustration assumes declared earnings of 6% and claims experience of 10% higher than expectations. So if these are met, her first-year annual premium, $3,762. So stay with me here. This is where it gets a little bit different. In year 1, it's not going to pay a flex credit, so her net premium is $3,762. Now let's go down to year 10. If those assumptions are met, the 6% and the 10%, her premium projected to be $5,185. Policy would pay her a flex credit of $1,248, and if she used that to reduce her premium, her net premium would be the $3,937. And let's go down to age 92. At 92, premium $21,799, flex credit $28,000, so her net premium would be 0. Now at LLIS, we're a little more conservative. So when I run an illustration, or when we run an illustration, we're going to assume 4% on declared earnings and 15% on claims. So we'd show you the illustration with that, and when we take that into effect, see how the premiums change because that flex credit changes. So in year 10, a $640 flex credit, net premium $4,544. At age 92, her net premium is still estimated to be 0. So you can see how the John Hancock policy compares to the other two, but keep in mind there are no guarantees on this page. None of these premiums are guaranteed, but this is the projections. I want to just make sure you understand this new John Hancock policy and make sure your clients know what all the options are out there for them. Now, after presenting these numbers to Barbara and Andrew, they've decided that Barbara wants to apply for a policy. So she did her app interview with our case manager here at LLIS. And during the app interview, we gained more information on her medical history. We knew that she had a family history of Alzheimer's because remember her mother had a prolonged illness with Alzheimer's. But we found out that she had cancer a year ago, but it was just basal cell. So that's okay. That would not prevent her from being insurable. And I forgot to mention about the family history of Alzheimer's. That would not make Barbara be uninsurable, but it would prevent her from qualifying for a preferred discount with many companies. Okay, let me keep going here. Discovered that she takes one medication for depression. Again, that would not prevent her from being insurable, but she could not qualify for the preferred rate. Takes a cholesterol medication and high blood pressure medication. Again, those combined medications would not prevent her from being insurable. But we found out that she has arthritis, and it's bone-on-bone arthritis, which is of much concern with underwriters, because keep in mind, underwriters for long-term care insurance are concentrating on musculoskeletal issues. They're concerned that a client may have a pre-existing condition that may prevent them from doing the activities of daily living, dressing themselves, transferring from bed to chair or whatever. So they're concerned about bone-on-bone, and that fact alone, unfortunately, makes Barbara uninsurable for traditional long-term care insurance. Now, she still wants coverage, and all is not lost. Jerry is here to talk to you about possible options for her, but before I pass it over to Jerry, I'm going to answer a couple questions that came in. One of the questions that I received is, how easy is it for clients to switch LTC policies if there are better deals out there than what they currently have, specifically for clients over age 63? Well, I will tell you that if your client has had a long-term care policy for a couple years, chances are there's probably not a better product out there if we're talking about price, if we're talking about premiums. The industry has changed. A lot of companies have come out with new products every 2 years or so, and with those new products are higher premiums. Also, with the new with the new policies, they've changed the amount of, or the options that are available. As you remember, years ago, we used to have unlimited policies. That's no longer available. We used to have limited pay policies. Those are no longer available. So I've done a lot of policy reviews over the last several years, and I don't think I don't even know if I've ever had one where I recommend that the client change the policy. Again, too, every year goes by, client's a year older, premium goes up every year. So if you have concern and you think it may be a possibility your client needs a better policy, send me the specifics. I'd be happy to review it. It may be, and most times it is, I recommend they keep that current policy, but maybe add a small policy onto there to supplement what they already have. So I'll be happy to help you with that. Okay, another question that came in, and okay. Okay, 27 minutes. Okay, question is asking, it says $27,000 per person paid out in claims for long-term care seems quite low when the average person is long-term care for 3 years averaging $70,000 to $90,000 per year. Does this mean that many claims are short-term, 2 weeks of rehab, and distorting the percent who really need serious long-term care claims? Yes, the majority of claims are a shorter period of time. A lot of claims are, I can't remember the specific percentage, but a lot of claims are for under 1 year of time. So a lot of claims would not be that typical 3 years with nursing home. So yes, the number does look low, but look at it compared to the other insurance and what they've paid out. So majority of claims are for a shorter period of time than the 3 years. This is one more question I'm going to take. It says, do the insured have access to a care coordinator during the elimination period? Yes, they do. The care coordinator can come into the home and assess the situation right away when you first make a claim, when they start the process. So the care coordinator comes in and helps get the whole claim started and would help you determine, okay, what is the best way to go? Should they stay in the home? Should they do assisted living? So yes, they can start all this before they even start to satisfy their elimination period. If your client has a long-term care policy, if they have a long-term care policy and their health starts to fail and they think they may qualify for coverage, then they should make a phone call to the insurance company right away, get the care coordinator out to the home, and start the whole process. That way they have things enforced and they can get the elimination period starting to run it down as soon as they can. Okay, I think that's all the time I have for these questions right now. I'm going to pass it over to Jerry.
Thank you, Jill. We do have another question that came in. It says, instead of paying long-term care premiums, the money was invested instead. How does that net worth compare, say, at age 80 or so? So basically, I think what the question's asking is that if the client didn't purchase a long-term care policy and was just to save money on their own, how does that compare at age 80? Well, one thing you got to remember is that with long-term care insurance, you're buying a pool of money. So most policies are starting out with a pool of money of somewhere between $200,000 to $300,000 right away. But if you have a client who's looking at, paying $6,000 a year for long-term care policy, they would never be able to pay that premium into an investment account and have it grow to where it would ever equal or exceed what you would have with a long-term care policy. All right, so going back to our presentation, unfortunately, Barbara was not insurable for traditional long-term care. So what we're going to do is we're going to look at some annuity options for Barbara. Fortunately for Barbara is that Andrew bought Barbara annuity 25 years ago. And what he did is he invested $150,000 into it. Why did he do that? Well, he wants to have everything equal between his two kids. And then at that time, Ben was starting his manufacturing business. So he gave Ben $150,000 for that business. So then, knowing Barbara's situation, he put $150,000 into an annuity for Barbara. And why did he do that? Well, he wanted to provide creditor protection and to provide income for Barbara in the future, and also wanted to protect her that if her husband or estranged husband ever came back into the picture, he couldn't get at the money inside of this annuity. It was all protected. And 25 years later, this annuity is worth about $625,000 today. So what we're going to look at is how we can reuse this annuity for Barbara. What we're going to do is we're going to take that $625,000 and we're going to split it up between three different types of annuity. First, we're going to look at a hybrid annuity. We're going to take $200,000 of that $625,000 and look at what can Barbara get with a hybrid annuity. Secondly, she's only making a little bit of income as a yoga instructor, so we're going to supplement her with some additional income. So we're going to take $225,000 and we're going to look at getting her an immediate annuity. And then finally, we're going to look at purchasing two deferred income annuities, each one for $100,000, starting those payments at different ages. So first, let's take a look at the hybrid annuity. With the hybrid annuity, one thing to remember, just like a traditional long-term care policy, all the benefits that are paid out of a hybrid annuity are paid out tax-free when they're paid for long-term care benefits. Currently, these are only available as single premium policies, which is not an issue for Barbara because we're going to be doing 1035 exchange from her existing policy. It is simplified underwriting, which is really going to benefit Barbara because she does have a series of or a variety of health conditions that made her uninsurable for traditional long-term care, but she is insurable for the hybrid annuity, and we can only use non-qualified assets when we're looking at a hybrid annuity. Now, going back to where long-term care benefits are paid out tax-free, that's really big for Barbara because she has such a large gain in that existing annuity. It's going to be a way where if she needs long-term care benefits, we can take part of those gains out of that annuity and give them to her on a tax-free basis. So with the hybrid annuity, we're able to leverage assets for long-term care. We're going to take that $200,000 and we're going to give her a much bigger pool for long-term care. Long-term care benefits that are not used in the annuity are going to pass on to her beneficiaries. It still is an annuity. So whatever not used in that annuity, in that account value, is going to pass on to the beneficiaries. The long-term care benefits are going to grow at a higher interest rate than the cash values, and you'll see that when we go over the annuity in a little bit more detail. And once again, those gains are paid out tax-free for long-term care benefits. So with the hybrid annuity, we have three options. So the first option is the annuity is broken into two parts. We have her $200,000 initial investment, and when she goes on claim, it's that original $200,000 is what pays the first 24 months of the claim. Then there's a rider that goes on the annuity, and that rider is going to extend that benefit period for an additional 36 months. And with that, she would have a monthly benefit of $8,408. Option 2 is basically the same as option 1, except that long-term care extension rider is now 72 months. So it's twice as long in that rider as it was with option 1. And because of that, our monthly long-term care benefit goes down just a little bit. Then option 3, our monthly long-term care extension rider is now 108 months, and our monthly benefit went down a little bit. So it's kind of like this. Option 1 gives us 5 years worth of benefits. Option 2 is going to give us 6 years worth of benefits, and option 3 is going to give us 9 years worth of benefits. So at the end of year 1, Barbara put in that $200,000, and here's the value of the annuity with these different amounts. So with option 1, her cash value is worth $201,000. Option 2 and option 3 with the greater long-term care pool, because we have a larger benefit period, our cash value is not as much. The reason that is because there is a cost to the long-term care that is within this annuity. So you have a bigger pool, so therefore you have a higher cost for the long-term care. And that's on the cash value. Then they have this long-term care accumulation value. What this is that's her original premium growing at a slightly higher interest rate than what she's going to get on her account value. So in the annuity, when we look at year 1, at the end of year 1, her long-term care accumulation value is about $700 more than her cash value. The long-term care extension rider, that's that rider, the 36, 72, or 102 months. And then we have our total long-term care pool. So these two numbers, the long-term care accumulation value, the long-term care extension value, equals our total long-term care pool. So Barbara's going to put in $200,000 into this annuity, and at the end of year 1, if she goes with option 1, and that's what we would recommend for her, her long-term care pool is $504,000 when and if she needs care. So if we fast forward out to age 82, we can see our cash value has grown on option 1, and so has our total long-term care pool has grown. That's because that long-term care accumulation value is continuing to grow. Hasn't grown as fast with option 2 and option 3, and that's simply because of the cost within the annuity for the long-term care. But if you look at option 3, we got $1.2 million worth of long-term care benefits. But with Barbara, what we did is we recommend option 1. The reason being is that it's going to provide 5 years of coverage, and that is going to cover a vast majority of all long-term care claims. So when we're looking at this, she's got $227,000 account value, but she's got $620,000 of long-term care pool. What this policy is going to do is it's going to pay her $10,335 a month. And how do we get that? We take that long-term care accumulation value and we divide it by 24. So how does this policy look once she starts going on claim? Well, that $10,335 a month that she would receive when she goes on claim is subtracted dollar for dollar from the cash value and from the long-term care accumulation value. So at the end of the first year of claim, her cash value or account value has been reduced to $103,000, and her long-term care accumulation value has been reduced to $124,000. And if we go out after year 2, our cash value and our long-term care accumulation value has been reduced to 0. Now, let's say after year 1 she was to pass away, her beneficiaries would receive this $103,000. Year 2, at the end, there is nothing that would go on to the beneficiaries. But this policy will continue to pay that $10,335 a month for the next 36 months under the long-term care extension rider. I got a question here. What company's policy is this hybrid annuity? This is a company that is called State Life. It's owned by One America. And a way to look at this is that this cash value and long-term care accumulation value, this is Barbara's money. The long-term care extension rider, that's the insurance company's money. So what are the advantages to the hybrid annuity? Well, it's the simplified underwriting. That is the real benefit for Barbara. It's going to provide immediate full coverage with over twice the benefits to her. Any benefits paid out are going to be income tax free. Remember that annuity where we're taking this money from, doing the 1035 exchange too, has a very large gain in it. So it's going to come out all tax free, all those gains. The remaining account value is going to pass on to the beneficiary as a death benefit. And if things should change, she always has access to that cash value in the annuity. And then the disadvantage to it is, well, we are in a low crediting interest rate. They did actually just increase the interest rates on this product this week. They actually went up quite a bit for seeing increases on any type of fixed annuity product, so that was nice to see. I got a question here. Given what you are presenting here, and if the primary risk is long-term care, why would anyone not choose the longest option based on the data presented? Would one not give up $25K in cash value for coverage of the primary risk? That is actually a decision for the advisor and the client to make. As I said, the vast majority of long-term care claims are less than 3 years. I'm looking at Jill here. What percent go over 5 years? I believe only 20% of claims go over 3 years even. So that's why we looked at the longer. By all means, if a client wants to do that, they can look at that. I will tell you from presenting this with several advisors and clients, clients don't like seeing cash values that don't grow. No matter how much we try to emphasize the long-term care part of it, most clients have went with either option 1 or option 2 when looking at this. So now we're going to change gears a little bit, and we're going to look at immediate annuities. Why? I love that. The little girl is screaming, why? I've got 3 kids, and I'll tell you, my middle child is my daughter, and this sure looks like my daughter when she was younger. Kids don't get the long-term benefits of eating the broccoli that is on their dinner plates. Well, it turns out we are not so different as we get older. Many people, like those kids who don't eat broccoli, they avoid annuities because they can't tell whether the policy is fair or not. They see, illustrations. We're going to put in $100,000 and we're going to get, $600 a month. To them, that doesn't look like a good deal to them because they're giving up $100,000, but they're only getting $600 a month. They don't get the long-term benefits of guaranteeing that income stream. So in 2015, so the first 3 months of 2015, 250,000 people have bought immediate annuities or deferred annuities. Of the people that purchased that, more than half of them were between the ages of 55 to 70, and 40% of them invested somewhere between $75,000 and $200,000 into these annuities. So why are these people buying these annuities? Are they different from the peers who didn't buy income annuities? And if so, how were they different? Well, like the kids who appreciate broccoli and those who don't, it is possible they were smarter, better educated, more financially literate, and therefore better able to appreciate the long-term values of annuities. They're definitely looking for guaranteed income in retirement. So let's look at the immediate annuities. I'm going to go over this very briefly, what the different payout options, just to make sure everybody understands what they are. There's payout options are broken down into 2 types. You got period certain and lifetime payout options. Period certain basically means that the annuity is going to pay for a set period of time, and that's it. If the client dies before they receive the last payment in that period certain, payment will just continue to the beneficiary. Payout options for lifetime. Life-only payout options are going to provide the greatest amount of income. We can add on guarantees to it, to the payouts, but remember, whenever you add on guarantees, it's going to reduce the payout to the client. So you got life with a period certain, life with installment refund, and life with cash refund. Installment refund and cash refund are my favorite options. They guarantee that the premium that has been paid into the annuity will be paid out. So for example, let's say we put in $100,000 into an immediate annuity. If the client passes away after receiving $80,000, the installment refund will continue those payments, those monthly payments to the beneficiary until that other $20,000 has been paid out. The cash refund option simply writes a check for $20,000 to the beneficiary. And we can do all these payout options as a survivorship, so we can add on a spouse, but in this case, we are not doing that because the estranged husband is not in the picture. So for Barbara, she's 57, we are going to take $225,000 out of her current annuity, and we're going to move it to the immediate annuity, and here is a sample of the different payouts that she could get. Also, the rate of return going to life expectancy. I'm often asked, what is the current interest rate that immediate annuities are crediting? I don't know. Even when I worked for the home office of an insurance company, I didn't even know what the interest rates were. But if you want to know what the rate of return is to life expectancy, I can calculate that for you. And no surprise that as the payouts decrease or we increase the guarantees to the client, the rate of return goes down. We can also add on cost of living adjustments to the annuities. The most common is an increasing payout option, somewhere between 1 to 5%, 3% being the most common. And there is, I believe, 2 annuities that offer a CPI-U option. That is a U, which means it's a subset of CPI, so it's not quite as high as what CPI is. Once again, going back to Barbara, she's age 57, $225,000 premium. That's her monthly premiums. If we add on 3% compound inflation, you can see that she takes a hit on that first payment when she does that. So what I do is 95% of the time, I don't really recommend COLA options to clients. As you can see for Barbara, if we go down here 16 years out, it takes that long just for the inflation option to equal what her level payment would have started at. And then when we look at the total amount paid out of the annuity, it's out to her age 85, which is almost her life expectancy. However, though, but for 5% of the time, some of your clients that come to you maybe just once, or we're putting a large portion of the client's assets into an immediate annuity, it's a way to leverage, the danger of inflation. We can add that inflation on to the payout. So how much guaranteed should we guarantee on an immediate annuity? Well, I say cover the basic expenses. So cover the mortgage, the rent, association dues, cover the utilities like electric and water, cover the groceries. Most people have an idea of what they spend every month on groceries, and we can't forget those insurance premiums. We want to make sure they're paid so that they're covered. So who should purchase an immediate annuity? Well, they want guaranteed income. Maybe they have older annuities or life insurance that they're no longer going to use for the original purpose. We can move it to immediate annuity and get them income. They need income that's going to start within the next 12 months. And they want to lock in a gain. Was just actually working with a client today who has some variable annuities. The gentleman's 70 years old, and he's concerned that the market's going to take a downturn, and he wants to lock in those gains and start looking at income. And it tends to be toward a conservative client. Not this kind of conservative that's or Rush Limbaugh saying these evil, mean people, and then we have an old lady playing a slot machine and losing her money. That's definitely not the kind of conservative. She's definitely on the more risky side. I got one question here on the immediate annuities. Can one buy an immediate annuity with qualified money? Absolutely they can. Just all the payments that they receive from it will be taxable. If we use non-qualified money, there is an exclusion ratio, so part of each payment will be return of principal until all that principal has been returned to the client. And then after that, it would all be gains to the client. So we're going to talk about deferred income annuities. This is kind of becoming a hot topic lately, and that's really because of the QUALIC contract. So I'm going to touch on it a little bit. It doesn't really apply to Barbara because her annuity is a non-qualified annuity, but I do want to touch on it because it is such a hot topic right now. So what is a deferred income annuity? Well, it's a cross between a deferred annuity and an immediate annuity. It's going to ensure Barbara from running out of money if she lives too long, and we're going to supplement her retirement solutions. So we're going to add on to her immediate annuity and provide her income later on. And it's going to provide guaranteed payment stream for her that's going to start in the future. So with a deferred income annuity, it has to be funded with a single premium. Guarantee income stream, it's going to start, it's got to be deferred at least 2 years into the future and could even be done 30 years or more. It's kind of like having your own private pension. Payouts are very similar to what we've seen on the immediate annuity. There are no lump sum payouts, so you have to receive an income stream. And there are death benefits available. Don't necessarily recommend them on this type of product, but they are available. And there are some tax benefits due by the owner when the payments are received, because we did get able to defer it, and they do have an exclusion ratio when they start receiving them. Now we're going to change gears a little bit here and talk about qualified longevity annuity contracts. Once again, they are single premium contracts. We can put up to 25% of a client's qualified accounts not to exceed a maximum of $125,000. We cannot use any Roth money or set them up as a Roth. The payments have to begin by age 85. We cannot extend beyond that. With DIA, we have all those different payout options. With the QUALICs, all we have is a life only or life and cash refund are the only two options available. And the biggest reason that everybody is so giddy about these contracts, we are able to exclude the value of the QUALIC from RMDs, which is going to reduce the taxes to the client. So here's Angela, who is Andrew's sister. She's 70 and a half, and she has $400,000 in a qualified account that she doesn't really need any of that money. But she must start taking her RMDs based on that full $400,000. Well, under these new rules, we can take $100,000 of her $400,000 and we can move it into a qualified longevity annuity contract. So what does this do? This makes her RMDs based only on $300,000. So we removed $100,000 that she has to take RMDs on and reducing her taxes that she's going to have to pay. So it's a way to delay RMDs on some portion of a client's qualified money. Now, going back to Barbara, at age 57, remember, we're going to look at purchasing her two deferred income annuities. We're going to start one with payments starting at age 70 and the other at age 80. As you can see, we have our income here without a death benefit, and that's typically what I recommend, or with a death benefit. I recommend without a death benefit. So as you can see, we're going to get much higher payouts going without the death benefit. And all the death benefit does is that if she should die before payments begin, her beneficiaries would get her original premium that she put in. Without the death benefit, if she dies before payments start, the money is just lost. The insurance company keeps it. But that's why they're able to offer such high payouts with this product. because that money goes to help fund the people who do make it to when payouts are going to start. You will notice here that I gave you the prices with single life with 10-year certain and single life with cash refund, and the payouts look like they're skewed a little bit. Like, why are those higher than what the life only is with the death benefit? Well, first off, when we start adding guarantees on, we have to buy the deferred income annuity with a death benefit. Now, when I put the slide together, I took the highest payouts that are available, not looking at which company it was. So these payouts here are not all for the same company. There's 3 or 4 different companies' payouts in here. So, and why are we seeing this? That, like, for example, with a single life, age 70, it's $945 she would get. But if we add with a cash refund, we would get $988 if we wanted a death benefit. So why wouldn't we do the cash refund in that case? In this case, and there's no reason why we wouldn't do it. But why are we seeing this? Well, just some companies are more efficient than others. Like when we look at term insurance, we got 30+ different companies we can look at. When we're looking at deferred income annuities, there's 10 or less companies that are out there offering them right now. So as time goes on, the numbers will get to more like how we expected as more companies enter this market. So who should purchase a deferred income annuity? Well, they should be healthy. They should definitely have longevity on their side. They want guaranteed income later in life, and they should have a strong probability that current investment portfolio will be outlived. Now, with Barbara here, like the first thing that says they should be healthy. Now, Barbara does have a lot of long-term care or a lot of health issues that affected her long-term care. But with the DIA, we're looking more at mortality, and none of those conditions she has are going to affect her mortality. They affect her morbidity, but not her mortality. So what did we do for income from Barbara? Well, first we're going to get her a traditional SPIA. We're going to put in $225,000, and it's going to immediately start paying her $1,120 a month, or $13,440 a year. Then we're going to get her two deferred income annuities. We're going to put $100,000 into 2 contracts, and time's going to go on, and then starting at age 70, she's going to start getting another $12,756 a year, and time's going to go on a little bit more, and then age 80, her income's going to kick in again, and she's going to get an additional $29,000 a year. So what did we do for Barbara? Well, first we got her the hybrid annuity, and Andrew knows she's also going to have access to that cash, and that annuity is going to provide her $8,408 a month for long-term care benefits. But if she needs that long-term care, this will provide her with additional benefits with a much bigger pool of money than if she didn't have that annuity. And she knows she's going to get money when Andrews dies, but if her estranged husband comes back into the picture, it may all get blown. So then we looked at a SPIA for Barbara. Barbara likes this because it's going to supplement her small income as she's getting from as a yoga instructor. And Andrew likes it because it's helping her start with a budget and getting her used to a regular stream of income she can live on. With the deferred income annuities, Andrew knows that when she's 70 or 80, probably long after he's gone, no matter how poorly she manages her finances, she's going to be okay. She's going to have this income stream coming in. And Andrew set this all up now so he has peace of mind that she's got a safety net of income and long-term care protection now and long after he is gone. So tune in next week to find out, will Carl and Ben protect their family business with business insurance and coverage for them and their key employees, or will Ben break away from the family business and create a competitor company, putting his dad out of business? Well, the suspense is killing me. I cannot wait to see next week's webinar to see how this all turns out, or next month. Did you know that we are going to be at the Garrett Retreat, and Keith Maurer will be presenting there? And our LLIS Assurance Academy is up on the website and accepting registrations. Top 10 things that make us different. We do these monthly webinars for you. We are not your competition. We do a lot of pre-underwriting to avoid surprises. I know we're running out of time here. We are a sponsor of all these different groups. We have product specialists in all the different lines of insurance. I am your annuities and hybrid specialist, but I also do a lot with life insurance too. We keep you in the loop of what's going on with your clients once they're in the underwriting process. And I do have one final question here. I have a client who is 91. Our SPIA is available to her. And unfortunately, no, the maximum issue age for an immediate annuity is 90 years old. Thank you, everybody, for tuning in today. Our email addresses are up there if you have any questions for Jill and I and you want to email us directly, or you can always feel free to give us a call. Thank you for attending and have a good night.